Hello and welcome to another edition of Nucleus Investment Insights. We are going to focus on income stuff at the moment, income securities. We've sort of seen in the last month, we've seen hybrids sort of exiled by APRA, or hybrids for banks, banking hybrids are exiled by APRA. And so I wanted to just run through the reasons for this, what it actually sort of says about some of the income investments that people have been actually investing in, and what are the options out there for people who are looking to try and replicate that income or try and find other sources to get to the bottom of what they're doing in terms of the income investments. It is worth noting that everything you hear today is general advice. It's not personal. If you do want personal advice, you can give us a call and we can have a look through what might be right for your situation. And also that if you like what you're hearing today, click the like button and subscribe. So just to run through what we're going to talk about, there is a number of different factors that I wanted to run through. And I'm going to focus around what the changes were that APRA is talking about. I'm going to look also at the different yields you can get from different securities, and then what are you going to do in terms of the transfer. So the first thing I guess we need to know is why has APRA done this? And the reason why is because, well, it's sort of been sparked by what happened with Credit Suisse. Credit Suisse, what happened there was, as they did the merger with UBS, the investors in hybrids basically lost everything. And so, which doesn't affect the Australian market and Australian investors that much, obviously, but it is just that warning shot across the bows, is that what is it? The Australian hybrid market is dominated by retail investors. So it's an average mum and dad sort of investing in these, and in sort of my view, that they're investing largely on the idea of the brand name. Here's Commonwealth Bank. I'm investing in Commonwealth Bank. It's giving me a 7% yield. That's better than what I can get as a term deposit. So great, I'll take that, and I'll rely on the fact that if something goes wrong, Commonwealth Bank's going to pay me out. And the reality behind it is these are securities that are the sort of the first in line to fall if something goes wrong. And so because of the way they're set up, retail investors just don't understand the risks they're taking, and professional investors, if they were going to take those same risks, would demand a much higher return. And so what we've seen is this sort of market where for a long time the idea was, we need to get education and we need to get people to understand it. We need to get them to tick more boxes and give more disclaimers and things like that, so they actually understand what they're doing. The reality is hybrids were easy to sell, particularly if you're a stockbroker in Australia. That you could, it's one of the few income investments you could get you could collect clip a ticket. You can collect your trading commission on that, and so that's why Australian brokers sort of pushed that, and we sort of ended up in this situation where we were selling what's a relatively sophisticated financial product. With a lot of risks behind it that people don't understand to ordinary investors. And that's, I guess, where APRA stepped in. So what are they doing? They're looking just to phase it out by 2031, looking to try and, as hybrids are rolling off, as they're sort of finishing up, then they'll be reissued into a different type of what's called Tier 2 capital for banks. And that Tier 2 capital is the capital that is sort of sits between debt and equity and is at risk, and it's sort of chances are it won't be rolled out in a listed manner. I think that APRA will be quite against that, and look more to try and make sure that what is being rolled out is the investors are professional investors who understand the risks and are pricing it, according to what they see in terms of other assets in that market. So it may mean a reasonable amount of more corporate debt issued by these. If you do own hybrids, you'll expire, you get paid out, assuming that we don't have any events before that happens, and hybrids will progressively expire over this sort of 8-year period, and so it'll sort of gradually work its way down and to nothing. And I did speak about, and so we titled this, the idea that hybrids are exiled due to bad maths. And it's a bit of behavioral economics, I think, in terms of the way you can think about this investing, is that when it comes to investing in stock markets, there's this upside. You can get as much upside as you possibly as the stock goes. So if Commonwealth Bank goes from strength to strength and earns a lot more money, then my upside is notionally unlimited. But it's I've got lots and lots of upside, and the downside is I can lose what I've invested, and that's it. But there is a potential I can lose it all. Within a government bond, you take the opposite side of it, and you're like, okay, I'm going to get a quite a low return. It's fixed. But as long as the Australian government is around or still owns a printing press, then I'm going to get my money back on that bond. And so that's your that's sort of sitting at the other end of the spectrum. Then you get into the corporate bonds, and it tends to be, well, as long as this corporate, I have a certain pecking order in terms of when things go wrong. And so things would need to go really wrong so far as all the shareholders get wiped out, and then all the junior debt gets wiped out, and then gradually works its way into the senior debt. And sometimes it might actually be secured against individual assets and things like that. So even if the company's gone down, maybe it's secured against property or other things that the company has. And so you're going to get paid out at least something out of that. And then traditionally it tends to be about 40%. So if you worked it out to say, well, there's a very low chance that the company goes broke. Maybe it's sub 1% or less. But even if it does go broke, I might still get all my money back. So there's this sort of relationship there, which is quite it's harder to calculate, but it's almost like lottery odds in reverse, insofar as people look at it and go, well, it's a low probability, and so therefore it's quite hard for people to try and work out what's the right number to come up with in terms of pricing that. And then you step up further down this line, which is where sort of these hybrids sit, is, well, okay, so the company runs into problems. What are the scenarios where hybrids can be converted into equity, or they can be converted into other securities, or sold, or just wiped out before you even get to any of the debt holders? And that's the part that's even more confusing and quite difficult to calculate. And you sort of need these long time series of companies going broke, and what are the odds, and what happens in those scenarios, and trying to work out what does it mean for this company. And it's complicated, and it's a low probability event. And these are the types of events that human beings are bad at generally pricing. So there's this argument about lottery tickets, that people will spend more for lottery tickets than what they're worth fundamentally, because it's this idea that, I put a little bit of money down and I might get this massive return. And so it doesn't sort of matter if if I put in $1, it doesn't sort of matter if my expected value is only 60 cents, because there's a potential that I'm going to make $1 million out of it. And so humans are quite bad at pricing those, which is why we have governments that regulate lotteries. And there's the idea that a very slight quick aside on that is there's another part of behavioral economics that says, well, actually, what people have really bought is you spent $1. Yeah, your expected value might only be 60 cents, but actually what you've bought for your 40 cents is the chance to dream for 3 or 4 days until and fantasize about what you might do with all that money. So, there's a flip side to it. But I guess that where I'm coming to from this, though, is that lotteries, because they're so hard to price for the average person and they get it wrong, is that they're usually regulated, so that only governments can run lotteries. And that's, I guess, what we're looking at for these hybrids, but in reverse, is saying there's a very small chance of a big loss, and so people are just bad at pricing it. And so that's where professional investors tend to be much better at pricing those types of things. So that's effectively why we've sort of ended up with where we are. And so the question then is, what else does this mean in terms of as hybrids go out? Look, it probably means banks are going to pay higher dividends or do some of these buybacks that we've seen in recent years, where they do a bit of a switch between they make an offer to buy back people's shares and include franking credits. And the reason why is exactly that, the franking credits. So what happens is a bank earns $100 pre-tax, and then they pay 30% in tax, and they've got $70 left to distribute. And that $70 has these franking credits embedded in it. And what banks have been basically doing is going, well, they've got more franking credits than what they want to spend in terms of paying out dividends. And so instead of paying out dividends, they've then bundled them up into these hybrid securities and said, well, if I can use those franking credits to pay my debt holders, and because the franking credits are basically useless in the hands of the bank, they want to get it out to either shareholders or debt holders. If they can use that, they can lower their cost of funding. So without this mechanism and without these hybrids, it's likely that banks are going to end up with more franking credits than what they can deal with. So they're then going to have to decide, well, do they just pay out a higher level of dividends and then buy back some shares, which is entirely possible. So basically the idea there is you want to pay out. We'll use those numbers before. We'll stick it into millions. So I've got I'd like to pay out $50 million worth of dividends, but I've got $70 million worth of franking credits. And so what do? Well, I pay out $70 million, and then I'd do a $20 million share issue. And so what that effectively does is it cancels it out for me, or a reinvestment plan or something like that, where I can actually say, okay, well, I've spent the $70 million, so I've got rid of all those franking credits and given it back to shareholders, but then I've sort of reversed it by issuing shares for that amount. And so in net, the company's still out only that $50 million. So that's quite likely. And the other thing likely is you'll see from banks is some of these events where what happens is they actually do a buyback, where the buyback is structured in this weird way. It'll get sent out to you in the mail, and you'll get offered to say, well, do you want to buy back these shares for, and it'll have franking credits attached to it. And it's sort of this weird structure where effectively it's a buyback where what's happening is to an international investor, they're actually saying, well, we're going to buy back your shares at a worse price than what they're going to buy back to Australian investors. And then even within Australian investors, what you're saying is, if you're in pension mode, for example, we're going to buy this back on really favorable terms. Whereas if you're on the highest tax bracket, the terms are less favorable. And so it's sort of that interesting part for investors when those buybacks do come out. It sort of depends really on what your tax situation is as to whether you want to be taking up on this. And what will end up happening is you'll see a lot of retirees and people in those positions where they'll actually be trying to accept the buyback and then maybe actually go and buy the shares. So you might say, okay, I've got whatever it is, $20,000 invested in this bank, and they're offering to buy back 10,000 of those, and so I'll actually give them the $10,000, but then I'll just go and buy another $10,000 on the market. So the net effect is I've still got my $20,000 exposure, but I'm getting this tax benefit along the way of the way it works. So so keep an eye out for those. But what I really want to get into next is what else? What are your other options out there? And what can we do? And what are the interest rates you can sort of see coming through from different markets?
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so I've got a quick table up for anyone listening in on the podcast, just of the hybrid yields you can get from roughly at the moment. And so, it's roughly in that sort of 7 to 8% range. And I'm talking about, these are the yields on the larger Aussie banks and some of the insurers as well. So it's a pretty attractive yield in terms of that. And that's why, and that's exactly the reason why is that regulators are concerned, is that, often when yields seem to be like they're too good to be true, is people don't question them enough. And so that's what you can get out there. What are your other options beyond that within the Australian market? And they are considerably lower. So term deposits, you're sort of looking at that sort of 5%-ish level if you're getting quite short-term term deposits. Anything in the longer term, you're sort of more like 4.5% on a term deposit at the moment. If you jump to government bonds, so an Aussie a 2-year bond is going to give you a 4% yield. 10-year bond is going to give you about 4.5%, and a 20-year about 4.8%. So you can sort of lock that in, and think about that as term deposit you can sell effectively. Is that you could right now, if you wanted to, you could stick $10,000 into a 20-year bond. You're going to get that sort of 4.8% yield over that time frame. Yield, or certainly yield to maturity over that time frame. And you're running the actual yield you get from year to year might be a little bit more or a little bit less depending on what bond you're actually picking up. So considerably lower, I guess, is what we're coming back to. You can where else can you go? You can go to corporate bonds. Now, you're not going to get much more in terms of corporate bonds. I'm just showing a chart here over the last sort of 20 odd years in terms of corporate bonds, and while it's at times they've been higher, at the moment on a triple B bond, you're looking at about a 5% return, and if you're going to get a better quality one, so triple B is sort of more like a typical sort of industrial company that's a little bit smaller and got a reasonable amount of risk to it. An A-rated bond is much safer, and you sort of go up to AA or AAA, and but an A-rated bond, you're going to get 4.5% ish, maybe a little bit more, maybe slightly more than that on an A-rated bond, but it's not that dissimilar. And sorry, these are 5-year ones that are just showing up at the moment. That's not that much more really than than what you're going to get on a government bond, and so this is an Australian corporate bond. So keep in mind that the Australian corporate bond market is actually quite small as well. So it is actually quite hard to get exposure in terms of corporate bonds onto this level. And the other thing to note is, and this goes back to the government bonds as well, is it sort of depends upon how you buy this as to what the actual cash flows are going to be. So it sounds a little bit weird, but let's talk about exchange traded funds. Is the way an exchange traded fund works is that they will buy government bonds on your behalf, and as new investors sort of buy in and sell out, they will then go and so let's say somebody comes to an exchange traded fund and says, okay, I want to buy $50,000 worth of government bonds, and they'll go to the stock market. They give the $50,000 to what's called a market maker. The market maker takes that $50,000, goes and buys $50,000 worth of government bonds, and then delivers those to the exchange traded fund. And the exchange traded fund then says, thanks for the $50,000 worth of bonds. Here's $50,000 worth of cash, which you can then use to go and pay the investor. And so, so it sounds, the reason why I'm getting to the minutiae of that is it actually creates taxable gains and losses within those funds, which means for bond funds, it may not actually be worth them distributing actually putting the cash out there. So the bond fund still gets the money. So you've got that let's call it $100,000 just to make the numbers a bit easier. That might pay dividends, it'll pay dividends over that time frame of say 4% or something like that, 4.5%. So there's $4,000, $4,500 coming in to that as income, which is attributable to that investor. But because of the tax situation and this buying and selling of funds and there's taxable gains and taxable losses within it, what will sometimes happen is the bond fund will actually say, well, it's not actually worth us paying out that money. We'll just reinvest that on your behalf. And so you still received it, you still got that return, and the money's still there in terms of your investment still increased by that amount, but they might not be actually paying the dividend or the distribution. And so if you're buying that bond fund because you wanted that money to come in because that's what you're going to use to fund your lifestyle, it might not be coming. You might need to then go and sell some of your bond fund to actually get that capital. So why is this important? Is that that's different to say if you do invest it through a company like Nucleus, where you buy the individual bonds, or plenty of others out there where you can buy the individual bonds as well. And what we tend to do is say a bond ladder, where you just have bonds expiring every couple of years, and you just keep adding more on the end. And sometimes you might take a bit of a bet at certain parts of the curve, but you will actually get the return from those bonds as it comes through. So you will actually see that as an income each year, which might be different within a fund. So I guess all I'm coming back to is, as a big picture, when you're investing in government bonds or corporate bonds, if you want that actual cash flow, you're going to take that interest payments and use that to live off. Just be a little bit careful in funds like exchange traded funds, where you might just actually need to sell some of it from a year to year to actually get that to get the interest that what you're expecting. Right. Okay. So that's your corporate bonds. You can go into annuities as well. So annuities are a product you can buy from a few different places. Tend to be insurance type companies. Challenger is very big in Australia in this area. And what you can do is, depending upon how you structure that annuity, they can be structured around fixed terms, or you can actually structure it sort of a lifetime term, and you can try and get inflation protection and things like that on it. And so depending upon what you want for those, it effectively turns into, it can turn into a little bit like a sort of a life insurance policy / investment, where it's a mixture of, they will pay higher yields for people who are, say, 80 versus somebody who's 65. Because the person who's 80, they're not expecting, they won't have to pay it out for as long. And so we're not expecting to pay it out for as long. And so, you might get sort of yields sort of more like an 8%, adjusted for what capital is coming out as well. If you're 80, there's that, as I said, there's that life insurance part to it as well. And so that's important to keep in mind. Whereas if you were, say, a 65-year-old, you might be more in sort of the 4.5% to 5% range that you're going to get for sort of a lifetime annuity along those lines. And also it's worth noting as well that if you are investing in these, men will actually get a higher yield than women, and typically it could be 0.5% to closer to even 1% difference, depending upon the age bracket that you're in, and that's based on that life expectancy part. So it's and it is the type of thing you probably want to be doing within super if you're going to get an annuity. It tends to be more tax effective within that within the super environment, sort of depending upon your own situation. So that is annuities. And the final place you can go, sorry, not the final place. The other place you can go with these is there's a number of different alternative assets in terms of whether you're investing in mortgages or various types of sort of what's called mezzanine funds or property funds. And so you can definitely get yields that are close to what you can get in terms of hybrids within those funds. And the issue, though, is you can be taking a fair bit of risk within those. So, for example, say you're going to be investing in some sort of mezzanine fund. Effectively, what you're doing there is what it means by mezzanine is you're not it's to a property. There might be a bank or something similar to a bank that's got a mortgage over that property, and they're going to get their money back first. So if something goes wrong and the property needs to be sold, that first mortgagee is the person getting their money back. you're then sort of relying on maybe a little bit of some of that property. You might be a little skewed. You might, if there's money left over, and after the whole sale process and all that type of stuff, you might be getting some of that, or you might be trying to get money from the wind up of the property fund that you've given the money to, or the investor that you've given the money to. So these mezzanine funds can give you some quite high yields. Quite often you can get 10% plus on that, but it's that there's a big risk behind that in terms of those yields. So there's a whole range of different funds out there and offerings, and quite often you'll see these sort of advertised on websites or in newspapers about how you can get sort of an 8% yield or a 10% yield on some sort of property security fund or something like that. And there's often a range of adjectives they'll use to try and give you that impression that these things are really safe, but then they're not. And so I guess if you are looking for that, either get professional help or do a lot of research within that to try and work out, are you actually getting something that's genuinely the right yield? Because there are lots of products out there that are going to try and step into this hybrid space and offer these 7, 8, 9% yields, and they might even start calling themselves hybrids or something similar to try and confuse people or give them that sense of safety. And so, I guess what I'm getting to is look out, because this space, typically has products that are much high. It's a space where there are lots of higher risk products that will try and sort of muscle in on this return. And the other place you can go is obviously the stock market. So, and I think this is probably where we'd be pushing people as you're moving out of hybrids. Well, first, if you're investing in them and you're comfortable with that risk, is saying, as they expire, or if you're unaware of the risk, maybe you should be doing this earlier. But moving into, say, a mix of dividend yields, so a mix of stocks and, say, government bonds. So what you're doing is saying, rather than having a sort of medium to medium high risk income investment in these hybrids, maybe you just sort of do what's called sort of a barbell approach, and you say, well, I'll take some much higher risk by buying some stocks where I'll get a dividend yield, but I've also got this capital upside potential, and then get some lower risk ones, some government bonds that are going to be lower yield and lower risk, and that's sort of going to balance out my risk profile. So I've still got the same risk as what you might have had within hybrids, but you've separated it into sort of a high risk and a low risk part of it. So you can sort of definitely get higher yields from the Australian market, probably closer to 4% within the Australian stock market. Internationally, that sort of falls away to just sort of high threes, sort of 3.5%. Say if you're looking at Europe, Japan, you can get sort of 2.5% yield within Japan. And then US investments are going to be more like sort of 1 to 1.5%. However, within those yields, it is worth noting that there's often sort of relatively high levels of buybacks, particularly in the US, where effectively what they're doing is they're reducing the number of shares, which means that each share should be worth a little bit more. And so effectively, I think the best way to think about a buyback is a company has a certain amount of money it wants to give back to shareholders. So let's say, go back to that example where we want to give $50 million back to shareholders. Is that Australian companies will tend to pay that out as a dividend yield, because we've got that 50 million, we're going to give that back to shareholders. We've got these franking credits, and so we just want to get them off our books, and so we attach the franking credits and off we go. And I spoke earlier about saying, well, what some banks will do if they've got these extra franking credits is they've got 50 million they want to pay out, they'll pay $70 million out and then raise $20 million to offset that. So theoretically, you're increasing the number of shares, and the value of each share goes down by a little bit. In the US, it's the opposite, and it's a tax reason as well. So many things are driven by tax, but in the US, it's much more tax advantageous for a company that wants to give $50 billion back to only pay out, say, 5 or 10 out to shareholders to sort of make a sort of bit of a token effort and some sort of cash flow, and then put the rest of it into a buyback, which will push the share price up, so shareholders still benefit from it, but it's much more tax effective for particularly US investors to get it through that way. So that's sort of the rough thing with yields. But the big thing I want to note with dividend yields is a big chunk of the Australian dividend yield that you're going to get, the excess dividend yield you're going to get, is because you've got so much banks and so much resources within Australia. So resource yields, resource companies tend to pay out high yields at particular times of the cycle when commodity prices are high, and particularly for iron ore and or particular for iron ore, that's right now, is that prices are high, and so yields tend to be pretty high that you can get from say BHP or Rio or Fortescue. The issue is these companies, they're not dedicated to paying out these dividends. They don't have a compunction. If commodity prices fall, then they will cut their dividends and cut them sharply. You shouldn't be thinking about a 6 or a 7% yield from a resource stock as being this great, here's 6% I'm going to get forever for the next 20, 30 years. It's a 6% right now. It could be 0 for a few years. It could bounce back to 8% for a year or two. It's going to bounce around all over the place. Maybe over over a 20-year period, you might be able to say it's going to be a reasonable yield, but don't be looking upon that as something that's a steady yield in any way. And so Australia is dominated by banks. It's dominated by resources. If you just looked at, if you excluded those companies, then the Australian yield is actually probably going to be lower than the European yield over the next 12 months, and actually not that dissimilar to what you might get, say, in Japan from dividends. Still a fair bit above the US, but where I'm getting to is if you invest in a high yield Australian fund, is that what you're really investing in is this idea that I want lots of banks and I want lots of resources in my portfolio. And if that's the case, you could have actually got a similar yield elsewhere by just doing the same thing. So I guess what I'm trying to get to is you're either getting are you getting a high yield just because of the sectors you've chosen? And then the question is are they the sectors you really want? And are they the sectors you're expecting to give a higher yield in the long term? And that's that may not be the case.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Now, the final thing before we get to investment outlook on these is I just wanted to highlight so there are some tax differences as well within some of these. So within bonds and government bonds in particular, depending upon how it's structured, but if you're investing in the individual bonds, quite often what you'll find is the gains or losses you make within individual bonds are actually reported back as income, and so there are opportunities where you're buying bonds. You can actually and certainly if you bought them at lower yields and the yields have gone up, that you can sell out of those bonds and take an income loss on that. So that's sort of, it's important to note, within those bonds, whereas other instruments, that's not the case. It is a capital gain or a capital loss. So keeping that in mind. There's also, I spoke a little bit about annuities and having a relatively significant tax difference, whether you're investing within super or without or outside of super. But that also flows through to other investments as well. And so particularly if you're looking at retirement or close on those, it can be a question as to whether in what entity you want to try and earn these higher yields. And so it might be that there's tax advantages for you to invest. So you've got $200,000 invested in your own name and $200,000 invested in superannuation. There can be times where you can look at strategies and say, well, actually, I do want to take all my income in one of these, or try and get most of my income in one of these entities because of the tax advantages through investing in that one, and try and get most of my capital gains into a different entity. And so you might run, you want to look at your overall strategy about what am I investing in, and say I was talking about this, you're moving out of a hybrid, which is sort of a medium high risk, and you're going into say shares as part of a strategy which is high risk, and government bonds, which is low risk. You might be then saying, okay, well, I'm going to take these in one entity because the capital gains treatment is going to be better, or the income treatment, or you're moving into pension mode, or whatever it is. There's certain elements where you can see that there's definite tax advantages to maybe putting one into one side and one into the other. And certainly, feel free to book in for meetings. We can and speak with our financial planner about what might be right based on your structure, your age group, where it sits, just so you can sort of your overall asset allocation is unchanged, but how you've separated it out into different entities can make a reasonable, couple of percent difference sometimes, just by sort of getting it into the right entities. So there's that part, and then the overall investment perspective then is just talking about saying, well, look, hybrids are being priced out because of this bad maths idea that people are actually quite bad at pricing sort of these low chances of a very negative result, and that's sort of coming back to then how you're going to treat these income investments going forward. First of all, be really careful about things with this high yield. Don't just go from hybrids where you're getting a 7 or 8% yield that you might not have understood the risks you're taking, and jump straight into some other, say, property, security, or mezz fund or something like that, where you're actually taking similar risks and just not understanding it. So and think about that, whether it's actually worth separating your returns into a higher risk portfolio and a lower risk portfolio, and ending up with that same sort of outcome. All that you can do, you can jump onto our website and sort of see if, different tilts you can run within your portfolios. Often it does make a lot more sense to own all these assets within your own name, so that you can get the full tax benefits of that. And it's your tax effects that are actually driving it, and your ownership of those that actually drives the yields you're getting, rather than if you're investing in a fund where you might actually see that your tax is getting mixed up with other people's tax, or you're getting those cases where the fund just isn't paying out the amount of yield that you're expecting because of their own tax issues and the buying and selling that's going on. Anyway, that's all for this week. You can tune in every Thursday at 12:30 for more. Pop in any questions or pop in any topics into the comments, and look forward to seeing everyone next week.